All right, so here we are with this trade. It's starting to draw down here. So I wanted to give you all something to think about. When you're in a trade, why did you get in that trade? Did you frame it out? Did you say that I have a 73% probability of hitting this target when XYZ happens and I enter the trade and my stop needs to be here because if it breaks this stop, then I have a 75% or 80% probability of this thing's going the wrong direction, or at least it will go too far the wrong direction that I won't be able to hold it. So this needs to be my stop. And then look at it and say, well, if my stop is there, my target is there, is that ratio something that I'm okay with? Is that a 1-to-1? Am I risking 3 to make 1? Like, what's happening with that ratio? And do I accept it? The next thing is looking at that spread. This is the target because that's where it's supposed to be, not because I want it to be there. This is a stop because it's where it's supposed to be, not because I want it to be there. And then I look at those numbers and say, can I afford to take this trade, right? How many contracts can I take in this trade, or should I take in this trade? Not really can I take, it's how many should I take based on my trade plan. And if one contract is still too much risk based on my trade plan, then I can't take it. And that's why I'm in the MGC. So if I was in the GC, this would be too much right now for my trade plan. All right, so then I get in the trade based on all of that, right? With the proper contract size and everything to fit my trade plan. And now I want to add to my position. Where do I add to my position? In drawdown or when the trade's going in my favor? So there are prop firms that tell you you're not allowed to add to your position in drawdown. And actually everybody I've seen on the internet tells you to never add to your position in drawdown, only when it's going in your favor. But why would you do that? So right here I got my add in drawdown because I'd rather add close to risk than close to target, increasing my risk. So right now, if I add to my position here, I'll be risking 1 because my stop doesn't change. To make 1 or 2, to make 2, based on my strategy, with a possibility of making 3. So add to my position, risk 1 to make 2 or 3. Is that the better way to go? Or add to my position up here, close to target, because this is the target. Probability says when this thing happens, this is the potential move. Anything after this is a casino trade. And if I don't have these probabilities, the whole thing's a casino trade. So if I don't know what's going to happen after here, I can't count on that. I can't factor that into my trade plan and my risk plan, any of that stuff, right? Maybe I get bonus money. Maybe it rips higher all day long and I can make a ton, but I can't do any numbers around that because I don't have probabilities to support it. So the only thing I can say is this is the target. So if I get in here, I add to my position here, right? I bought 1 contract there. I add 1 more here. That's the target, but my stop doesn't change because that's the move. That's the probability of the move. So now I'm in to make 1 here, but I'm risking 3 to make that 1. Does it make more sense to risk 3 to make 1 or to risk 1 to make 3? By adding and drawdown, that's my deal. Now, with that said, maybe you can make a ton of money risking 3 to make 1. Only thing that matters, traders, is what works for you, right? Forget about the noise. Forget about the rules. Who cares what anybody's telling you on the internet? If it works for you and you have a thing that makes you money consistently year over year, that's awesome. Do it. Forget about what everybody else says, right? I add to my position in drawdown because I want to be closer to my risk. Now, if you're adding to your position when it's going in your favor and you're moving your stops up and all that stuff so that everything numbers-wise works out, then maybe there's something there. I don't understand it. I would love to hear in the comments what your thoughts are. But, for me, it's like this. When I get into this trade right here, and let's say I don't even get to add to my position. It's just a 1-to-1. Great. Then my next trade, if it's a loser, as long as I'm risking the same amount of money or roughly the same amount of money, say $100, then this winner will pay for that loser. If I add to my position here and I lose, then it's just, basically I'm losing, say, $125. But the next time this happens and I win, I'm winning $175. So now I'm making a lot more than my losers. So these winners are paying for my losers again. But if I add to my position up here and that happens, then my winners are not paying for my losers and my account is going to slowly bleed out. So just something to think about, traders. Again, whatever works for you, do it. But I just want to give you food for thought because I hear this noise all the time on the internet. Don't add to drawdowns. Only add when it's going in your favor. So love to hear your comments below what you guys think about it. But that's my thoughts. Just sharing my opinions, what works for me. Definitely not trading advice or anything like that. Trading is risky. It's speculation. And I'm just sharing my journey with you and my thoughts. Not here to tell you what to do by any means. When I'm tracking my trades, like I track all my trades. I do my back test before I even want to do something. Back test looks good. I got, my entry, my exit. So my stop and my target is there because that's where it's supposed to be, not because I want it to be, right? And then I look at that, frame out the trade. Then I say, can I afford this trade? Looking if I get in the trade here, and this is where my stop has to be because probabilities say this is where it has to be. Can I afford that loss? And then if I can't, which I couldn't on this trade, so that's why I went to the micros instead of the minis. And then if one micro is still too much money, then I can't take the trade. But if I can, maybe I can get two. So then I start to figure out what my contract size is, my position size is based on the risk that my trade plan allows me to have. I don't put my stop somewhere because that's where I want to risk. No, the stop goes where it's supposed to go. I don't put my target somewhere because that's how much money I want to make. The target is what it is. Now I can squeeze more out potentially, but move my stop up, capture that target, and let it run. But those are the targets, and that's a stop based on probability. So then position sizing is where my money management, my risk management comes in. All right. So now tracking, I track all that stuff through backtest, then through the simulator before I get into real money, wasting money in a prop firm, all that stuff. Make sure it all works. And then I start trading it with just small bits of money to see if it's actually going to work. Mentally, can I support it? Does it actually fit me, my personality, all those things? And I track it separately. So right here, I entered that one contract right here, and that goes in the log as one trade. And same thing, back testing and all that stuff. This is trade A. Adding to the position is a whole nother trade. That's trade B. It's like if I'm trading a whole nother ticker. It's like if I went over to the Dow Jones and jumped into it. Completely separate trade. So my first trade, I have a risk 1 to make 1. Trade A. Trade B, I risk 1 to make 2 or 3. Most of the time it'll be 3, but potential, my minimum target is 2. In other words, I don't want to exit my trades before they hit the target or the stop. I do that a lot of times. And if you find yourself doing that, the question I ask myself is, why did I do that? And the answer is always, I had too much risk on that trade. I didn't feel comfortable with it, and it made me emotional. And I made an emotional decision, not a logical, statistical decision. And every time I have too much risk on a trade, that's what happens to me. If logics and statistics go out the window, emotions take over, and then it's bad news. So, but that's a good sign that, I'm having too much risk from my emotional fitness, and I just need to reduce that risk. Go on my trade plan, make adjustments, and it might not be for every day. It just might be today. I might be having a rough day. Life might be influencing my emotional stability, and I need to scale back on the risk in order to be able to properly trade. So that's something that's there. But then I start tracking these things separately because, if every time it comes down and crosses this level and I'm adding to my position, I find myself getting stopped out, then what I might discover is that this is no longer valid. It might have been valid through back testing and through sim trading. And now that I'm in the real markets, market conditions have changed and this is no longer valid. So as I'm tracking it, I might have started with a 73% probability, and now it's down to like 65%. I need to stop trading it because now I'm getting into a zone that I'm not comfortable with, and I need to reevaluate. The other thing that's starting to tell me is that if I keep on tracking this, and I might see that, most of the time when it crosses here, it does hit the stop. Well, then why is my stop all the way down there, right? Now it's time to move my stop here and look at a different trade setup. Like strategy is changing basically. Or what I might find is that most trades I enter, I find myself adding to the position, and then it hits the target up here. Well, if most trades I enter hit this and then hit that target, then maybe I don't even enter my first position here. Maybe I just wait for the retrace. I get in heavy on the retrace, and then I go for it. Because if I have a daily loss limit of $1,000, well, I can't risk $1,000 in this trade here and then add to this position and have room for this target, right? I would get stopped out somewhere in here, so I can't do that. So if I'm getting in with, say, $500 risk here, $500 risk here, basically when it hits a stop, I'll be risking 1,000. Then I can do it. But at the same time, if I do that, then part of my risk, I'm just risking one to make one. Whereas if I can wait, get in here, risk the full 1,000. Now I'm risking 1,000 to potentially make 3,000. So it could be a better day. So by tracking them separate, I start to be able to see how things are playing out with the current market conditions and what's the best options for me. Do I stay with this setup, breaking it up, or do I just wait for the retrace and go for risk 1 to make 3? The argument against it, and the reason why I'm not doing it now, is because not every trade comes back down here. Maybe 5 or 6 out of 10 trades come down here before going up. So now I'm missing out on a lot of trades. Financially, I actually make more money breaking it up this way than if I just waited for them to hit this target to risk 1 to make 3. Psychologically, it's a lot easier to deal with risking 1 to make 3, but financially, it's a smarter decision for me currently based on the current probabilities to do it the way I'm doing it. So just something to think about when you are scaling in and scaling out. Do you track those as separate trades so that you can see how each individual, entry and exit affects your bottom line, and then you know which one you need to work on, right? Because if your account is starting to go down, maybe you don't throw out the strategy. You just throw out the scaling part, or you adjust the scaling part. The strategy itself is fine. It's just the scaling part's off. But you won't know that if you don't track it separately. So something to think about there too as well. All right, let's see how this trade plays out. Again, interested to hear your comments below. And good to be back. Next week, I probably won't be able to trade that much. I mean, we do have Christmas and all that stuff, but I also have some clients that have budgets they need to blow before the end of the year. So there's a lot of commercials and music videos and things like that happening right now that I've been really busy with. And also some shows that some wealthy clients wanted to have. So it's been a crazy busy time. I really haven't had time to trade at all. But hopefully I'll be able to get some more trades in before January. I'd like to get this account growing again before January, but I don't think that's going to happen with the holidays and taking care of my clients. So if we're behind schedule, we're behind schedule. All good. That's another thing, traders. Be careful of self-imposed deadlines. You get into a trading account or Combine or XFA or a live account and you say, by this time, I have to have this much money. That's going to influence your decisions, So you got to be careful with that. I like to have goals, but at the same time, I have to be careful that I don't let those goals influence my decisions. And they almost always do. Like if my goal is $10,000 and I get to 9,800, then I start to get scared because I don't want to go away from my goal. I want to hit my goal. And I'm afraid to get in the trade, and I start to find myself getting emotional around that number. And a lot of times it affects me in a negative way. So you got to be careful with goals sometimes, especially if you have deadlines. Don't make them deadlines. It would be nice to have, $10,000 by middle of January. That would be great. And if I don't, all good, kind of thing. So anyway, just more stuff to think about. All right, let's let this trade play out. I'm done talking. We'll see you at the conclusion. All right, so I just took off the ad that was here, moved my stop to break even plus a few dollars because the gold market closes its normal trading hours at 1:30. And my strategy has me trading it between the normal trading hours for gold, not outside of that. It's okay if it carries over outside of it, but I need to move my stop to break even plus a few dollars. And then if I get lucky and it wants to keep running upwards after normal trading hours close, great. But the rules are that because once trading hours close, my statistics change to the negative side. So not good enough to stay in the trade.
Stop, Phil.
All right, there we go. So out of that trade. So that's going to put me at $50.50 today in the live account. And I'll slowly get this thing rolling back up to its full potential.
Order filled.
Okay, so we just added to the position. So you can see it automatically added to the stop and the buy there. That's the system. It's just the probabilities go down after the gold market closes its normal market hours. So now the trade's kind of not in my favor. I wouldn't say it's against me, really. I mean, the trade's not in my favor because, you know, when I started this trade, I had like a 73% probability that is now like a 65% probability, which is a probability zone I don't like to be in. All right, so hold on, okay. All right, so here we are at the end of day. So still in this trade in the green, and basically it's time to get out. We got 4 minutes left before the market closes, so I'm gonna go ahead and move my contract, my position down, capture this, and we'll just keep trailing it. You know, if this wants to go against me at the last 5 minutes, I'm never going to be able to recover with only a few minutes left on a day. So there we go. All right, so that trade is out. Took that trade. So $85 in the day. Pretty sweet. So you can see how adding to the position can definitely help if I'm adding close to risk, if my strategy supports it, if I have a proven statistical probability to support that activity, and it's part of my trade plan. So there you go. All right, see you on the next trade.